Today we're analyzing Ford Motor Company. They are currently trading at $12 a share. Let's check out their 5-year chart. They're up 23%. They also pay all their money out in dividends, so I'm sure with dividends that would be much higher, but it's tough because they pay a special dividend. So their dividend yield is not consistent. Uh, so you can't just count their dividend yield towards their return. But they are a $50 billion company, and they've got a price to earnings ratio of 13. So pretty low price to earnings ratio currently. They have razor thin margins, so that makes it tough, especially being a vehicle manufacturer, which is a highly competitive industry, makes it tough. So let's look at their revenue. Their revenue growth has been very all over the place. I'd say overall, you'd probably be looking at like 2% a year, just keeping up with inflation. It's tough because it's like kind of cyclical. It's up and down, really depends on vehicle sales, whether people, or it really depends on the economy, really. Like if the economy is strong, then they sell more, and if the economy is weak, then they sell a lot less, and that's how it works. They were up 11% last year. Last quarter, they were only up 3%, so that might be an indication of a slowing economy. Let's Their gross profit margin is pretty low. Like I said, a competitive industry, so they're going to have to price their trucks accordingly. Their operating income also is very low, and their margins just are really slim. So sometimes they'll have losses. Like here, they had a loss. Here, they had a great income gain, um, most likely from this non-operating expense. Yeah, miscellaneous. Yeah, sometimes it's tough to value these businesses because there's a lot of things going on here, but we're gonna do our best. Yeah, this business might be better to value based on EBITDA, 11 or 12 billion in EBITDA. But let's take a look at the balance sheet here. And their balance sheet has $110 billion in net debt. That's a ton of debt, especially when you're talking about a company that has a $50 billion market cap. So their net debt is twice as high as their entire market cap, that's a lot of debt. It really is. In terms of cash flow, they have pretty decent cash flow most years. Yeah, but what they're doing with it is they're paying it all out in dividends. They barely do any buybacks. So they paid out 5 billion in dividends last year, which is like a 10% return basically. So that's not too bad. Although that is the first year they've done that in a long time. Let's take a look at their segments. So they've got Ford Blue, which is basically like smaller vehicles, and then you've got Ford Model E, which is their electric vehicles, and then Ford Pro is their trucks. And we can see the units that they sold. Well, they sold the most Ford Blue, their revenue. Uh, they had the highest revenue in Ford Blue as well, and then they barely sold any electric vehicles, and they also had massive losses with electric vehicles. It'd probably be smart for them to kind of exit that market. I don't really, yeah, the electric models are not working out for Ford, but their trucks are highly profitable. In terms of their margins for the Ford or for the trucks is 16% EBIT margin, which is much higher than their Ford Blue, and Ford Model E is way negative. So yeah, if they could focus on their trucks, then they would be much more profitable, but they aren't, which is kind of annoying. Let's look at the analyst. So the analysts are projecting 1.93 in earnings per share for this year, and then next year pretty much the same. And the revenue is going to stay pretty flat, 2%, and then 2% growth as well. Let's check out their stats, see what their short percentage is. Short percentage is almost 4%, which is kind of high. That's kind of a red flag. Yeah, vehicle manufacturers are tough because they have a lot of debt and they are in a highly competitive space. So probably the reason why they're so heavily shorted. Let's look at what else should we look at? Or what was I going to look at? Oh yeah, insiders. We can look at the insiders. Well, the insiders don't really own a ton of shares, but in Q4 that there was actually an insider that bought 2 million shares or $2 million worth at $11 a share. So if it gets back to $11 a share, maybe that would be a buying opportunity for the stock. Let's look at the model that I have for these guys. Oh, I was going to look at that. Okay, one sec. Yeah, I was going to look at the analysis, right? They're projecting 1.93 in earnings per share. Let's see what they did last quarter or last year. Last year they did $1 in earnings per share, and the only last time that they did 1.93 is way back in 2017. So maybe they'll hit that. I kind of think that they won't be able to hit that earnings per share number. Well, actually, they did $4 a share here. Yeah, this business is tough because they've got a lot of unusual expenses. But yeah, and they have a high interest payment. But yeah, I'd say last year would probably be what they should expect next year, which would probably be around maybe a buck 20. I'd say they probably make a buck 20 next year. So I think the analysts are off here, but yeah, we still use the analysts in our projections. So I put them into the spreadsheet, put the EPS estimate there, revenue estimate there, buybacks of 0. They don't really do any buybacks. Net debt of 116 billion. We got to factor that in. Discount rate of 10% because I want a 10% return on all of my stocks. Exit multiple of 15. Right now they're trading at 13. I've seen them trading at 6 before. I think an exit multiple of 15 is pretty fair for this business. It might need to be lower just because of how competitive the space is and like how low growth this business is. But we'll go with an exit multiple of 15 to be optimistic. And we're looking at a growth rate of 2% in their earnings from $1.93, which seems pretty high and unlikely. But in this case, then the fair share price is $26, um, which would make it currently way undervalued. But if you factor in the debt, then the fair share price is negative. So yeah, the debt really hampers their abilities here. And I would probably put their fair share price based on these assumptions at maybe like somewhere in between here, probably like 18, maybe 16 or 18. Yeah, it's tough because yeah, just it's really hard to value companies with so much debt. But we can use the revenue margins model as well, and the growth at 2% a year in their revenue, because it is a mature business. I think that's fair, and the profit margin at 2%. Sometimes they have years where they have negative profit margin. Sometimes they have profit margin at like 4%. So I think 2% is fair. They might be able to do 3% a year on average. Um, in this case, they're worth $11 a share, which is yeah lower than what they're trading at now, and their fair share price after you account for their debts is way negative. So yeah, the debts really make a difference here. Let's maybe they get a profit margin of 3% on average, which I feel like this could happen, but it's more optimistic. And then we're looking at a fair share price of $17, which is not really that much better than their current price of 12. Especially when you account for the debts, it's still negative. Yeah, I just don't really like car companies just because of how competitive the industry is. Every time you look at a car company's chart, it always looks awful. Like if you look at the all-time chart for Ford, it's just up and down, up and down, up and down, and it doesn't really move anywhere. So I would expect this moving into the future. I bet you 5 years later they're still trading at $12 a share. Oh wait, my bad. Um, yeah, this is their all-time chart. I'd say 5 years later, they're still probably trading at $12 a share. You might collect a bit of a dividend, maybe like 5% of a dividend. Um, it, yeah, that's kind of what would expect moving forward. I would expect maybe like 5 or 6% returns overall. So yeah, I would have personally avoid these types of businesses. That's my thoughts. Let me know what you guys think in the comments, and make sure to hit that like button for more videos, and I'll see you in the next one. Peace.